Thank you so much, everyone, for coming out this morning. I know it's nice and early and it's a nice Thursday and it's a beautiful day out there, so we really appreciate having you in the room. As Nick said, my name's Grady Wulff. I'm the market analyst with Bell Direct, and my job is to literally live and breathe the markets and to help our clients understand exactly what is going on in this really volatile, somewhat stressful time in the markets. And obviously we're at record highs at the moment in Australia and all around the world on different markets. Obviously the US this week, S&P, NASDAQ at record highs. So what is going on? Let's navigate it together. Just a quick note, anything I do say today, this is a legal team tick off for me. So anything I do say today is simply information only. If you do like the stocks I'm talking about, feel free to do your own research. It's information, not advice today. Legal team don't get paid if I don't say that. So who is Bell Direct? Just quickly, we're an online trading platform, kind of similar to CommSec, but better, I like to say. If you'd like to join our team, we'd love to have you. It's free to sign up and you get access to Bell Potter Research, my commentary every day, exclusive CEO interviews that I've done at the conference in Sydney, and all of our clients get access to all the different reports that there are that we're producing every day. So why not join our Bell Direct team? We'd love to have you, and it's our job to make your investment journey as easy and simple as possible. So I thought we'd start today by looking at what is going on in the markets and where the opportunities are right now. So as you can see, this is a sector, these are the sectors that are catching my eye at the moment. And what I'm seeing and what happened, obviously we have some key events there, COVID-19 in 2020. Naturally, markets were sold off because we did not know what was going on. The only sector to go up in that time, as I'm sure you'll notice, is the healthcare sector. That's the opportunities we've seen, but that sector has outperformed the market on a 10-year basis. But just this year, we've seen the tech sector outperform the healthcare sector. But what's driving the tech sector up 58% locally this year? It's the AI revolution. Now, most of you in the room, and I know for myself, I think I've missed the AI bandwagon if I don't have shares in NVIDIA right now, but that's simply the case. It is true, but you can get diversified exposure to AI through some of the companies that are presenting today. I know DevX is in the room right now, and Todd will explain to you how you can get exposure to AI through uranium. So it's a really exciting time, and don't think you've missed the boat, but there are different opportunities and diversified ways to get exposure to AI. Goodman Group is another one. They have industrial REITs. Their infrastructure is really focused on data warehouses right now. You can get exposure to AI through water, energy. More power than ever is needed to power the AI revolution. So that's something that you can consider to get diversified exposure to AI and still capitalise on the upside to this tech sector rally that we're seeing in 2024. Materials obviously have come under pressure recently. That's simply because of the Trump election coming in, or the President-elect Donald Trump coming back into office, and also with China, the very slow and sluggish recovery post-pandemic. So that's something to keep in mind. A lot of news and noise is moving our materials space, but there are opportunities and seriously undervalued companies in this space right now. And then obviously the retail space, we are expecting, or consumer discretionary has really outperformed. We're expecting that to come down to single-digit earnings growth in the next year, simply because we've seen the retail spend coming down. So that's something to keep in mind as well. So with your portfolios, you need to really move it around and have a look at the best diversification you can to weather the high interest rate environment for a little while longer. So what factors for me are moving the markets right now? Obviously Trump, there's a bull up there for a reason. Trump 2025, tariff, stimulus, spend and policies are driving the market outlook. It's just after Trump was elected and announced as a new president coming in next year, we saw markets rally, and that's generally what happens after anyone is elected, so that's nothing to be concerned about, but markets did go up. That's because we've seen what the outlook is for what he's going to bring in. So I think when Trump comes in, inflation is going to rebound significantly because he's promising this really high spend. He's also putting tariffs, he's said, on China, Mexico, Canada, any imports from these countries. What that does is stimulate domestic spend and domestic demand, but also at a higher price. So that says higher price, higher cost, higher inflation. So that's really going to impact the markets over there and what we're going to see on the inflationary front as soon as Trump comes into office. There's also ways to get exposure to that. We've seen that in the Australian market. Reece Plumbing shares, James Hardie Industries, these companies really benefit from that kind of spend out of Donald Trump, simply because he's putting a lot of spend into the domestic environment, and that's stimulating demand for these companies. James Hardie makes 73% of their revenue in North America. So that's going to stimulate demand in that region. They've really got the market-leading advantage in that area for their fibre and their cement offerings in that area. So that's just a simple way to understand what's going on in the US when Trump comes in, and it's definitely an opportunity for some of our ASX-listed companies. Inflation and rate cuts. GDP out yesterday was weaker than expected growth, so that's a very good thing, but I don't see rates coming down anytime soon. Key inflation drivers are remaining sticky. Wages inflation, input cost inflation, services inflation, they are all remaining too high. Immigration is really high, and obviously housing prices as well are really high. So, and I don't know anyone who's going to want to sell their house lower than the value that the market's putting on it right now. Especially living in Sydney, I think I'm going to be homeless forever. No, I'm just going to be renting forever. So looking at that, we've got too much inflation drivers right now. We have seen retail spend come down, which is a big tick. But then again, we've seen the Black Friday sales just gone, have really pushed about $6 billion into the economy, into the retail sector. So again, this is not great for our inflationary environment. We've pushed out our expectations to mid-year next year for the first rate cut, possibly, but in saying that, we were saying January about 6 months ago. So that it's changing with every piece of economic data coming out. So that's just something to keep in mind when you're looking at the inflationary front. I would love a crystal ball to know exactly when rate cuts are coming, but it is really an economic data-driven market right now, and economic data is really driving our rate cut outlook. AI driving uranium is really interesting. So as we saw recently, Microsoft have put a lot of money into restarting a nuclear power plant in the US to power all of their AI for the next 20 years. What this says, uranium is the commodity that's going to be that is used to power nuclear power plants. So there's going to be a demand upside for that commodity and supply downside as well. There's not enough supply in the world right now. So that really puts our focus onto different uranium companies. We are very bullish on uranium, and we'll get to that a little shortly, because I've got 3 commodities that I'm looking at the moment. FY25 outlook is as expected. We've seen the first quarter updates come out recently. Single-digit earnings growth is the kind of key takeaway we've seen. That's across the board. It's not just single sector. It's across the board. We're seeing earnings growth depreciate in this higher inflationary and economic environment. That's nothing to be concerned about. It's just a pullback from 2024 results. And mega cap valuations are seriously high, and that's what's driving the market right now. Obviously, markets are at record highs in Australia and around the world, but it's not across the board. It's single drivers of this rally. There are serious mega caps that are driving the rally, and really the pullbacks that we see are simply because of people selling out of the mega caps. So the opportunities I'm seeing are in the small to mid cap space, and that's exactly where we're playing today, obviously in this mining conference. So let's dive into 3 commodities. We are bullish on gold at the moment. Gold is obviously the price is at record highs right now. We saw $2,700 US an ounce, which is a 50-year high. Recently, the drivers of the gold price, it came back recently because of Trump's election announcement, but we're seeing it go back up again. What this says is that the drivers and the tailwinds for the gold price do remain and are going to remain well into FY25 or CY25 as well. So the drivers of that safe haven asset, a lot of people are thinking that the markets at the moment are at record levels. So where do they go? They go into gold because it's a store of value and it's safe haven nature. We have the People's Bank of China buying up more bullion than ever before because they're trying to de-risk themselves and diversify their ownership of portfolio and kind of tie themselves away from the US dollar. We've got a lot of investors hedging against inflation with gold. We've also got the outlook for the commodity being really high, not enough high-grade gold coming through as well. So that's obviously pushing on the demand and supply side there. So we are bullish on gold, and we have an outlook for at the moment a buy rating on Capricorn Metals. So we love Capricorn Metals because of they're a sector leading producer. They've got 2 mines, the Karlawinda and the Gold Project and the Mount Gibson Gold Project. They recently upgraded their ore reserve by 41%, so that extends the mine life that you're looking at for this gold mine at the Mount Gibson Gold Project. And the all-in sustaining costs are quite low as well. So when you're looking at a gold miner or a miner of any kind, you want to see low all-in sustaining costs against high sales prices. But you also want to look at their hedging at the moment. Obviously, as a gold miner, you don't want to be hedged or tied down to a hedge or forward contract because you're missing out on the potential upside of the high spot price right now. So Regis Resources, we saw paid out their hedging book in December last year to capitalise on the spot price and the upside of the spot price that we're seeing at the moment. So hedging in this area, you don't want to see hedging in a gold miner right now, you want to see spot price sales. And it's a completely different story for other commodities. So that's something that you need to consider when you're looking at the different commodities out there. And the other reason we like the Capricorn Metals is that they have really strong gold grades as well, and having 2 mines diversifies their earnings. So when you're looking at a miner, you want to look at how many assets they have, how many mines they have, and because we want to see that there's earnings and revenue coming from multiple areas. If they have single earnings and single mine, that's okay as well, because Pilbara Minerals is exactly that. But you want to see different kinds of earnings, because if something happens to one of their mines and it has to go into care and maintenance, or it has a shutdown or something, that really impacts earnings. So you want to look at the different assets that they have and ensure that they have different revenue streams coming through. Or for like of Mineral Resources or Develop Global, they have the mining services division as well as their assets. So diversified earnings is really important. So I thought we'd talk about lithium as the second commodity today. We are cautious on lithium. We don't see a rebound in the price of hydroxide, concentrate and other areas of lithium until at least FY27. Demand is there and it's still going to be there, but I think what we're seeing in the market is that we raced into this EV green energy transition a little bit too soon. With that, I mean that a lot of people got Teslas early and then realised that they can't charge them at home or they can't charge them on the road. They only have 400 kilometres in the tank, and then which is fine. But Hertz, for example, in the US, just sold their whole fleet of electric vehicles because a lot of the hotels people were getting, they found they were stuck on the side of the road because they didn't realise how small the tank was, and also the hotels they were staying at didn't have the charging ports. So what we're seeing is a bit of demand pullback at the moment in EVs, but that's not expected to last forever. And so we will see an upside potential for lithium in the near future. FY27 is what we're calling. We're seeing stabilisation in the price right now. Pilbara Minerals, if you're going to hold any lithium stock, Pilbara Minerals is a stock that Bell Potter has a hold rating on, simply because they're a really low-cost producer. They have the biggest asset at the Pilgangoora mine in Australia, and so obviously the world's largest independently owned asset there. It's a hugely strong management team under Dale Henderson and the team there. They've done it before. They're doing an exceptional job right now. And they have a really strong balance sheet. So when you're seeing a downturn in the commodity cycle, so for lithium, for example, right now, you want to see a strong balance sheet so the company can weather the economic cycle and storm that we're in. So Pilbara Minerals is definitely the stock on our radar for that. And they've ventured into the downstream operations as well. So with downstream operations, that's where the margins are made. That's converting the lithium through to the final end product. So that's where your margins are made, and that's what you want to see. Again, going back to that diversified earnings that we're seeing there. And the last one we're bullish on is uranium. Uranium is definitely on our radar right now. A lot of countries around the world turning back on nuclear power plants simply to get through this energy crisis, but it also plays into the green energy transition. 2 years ago, we saw coal was the commodity of the year because Russia cut all of its commodity supplies to different parts of Europe. They had blackout periods, so it turned the need for uranium and nuclear power back on. What that says for us is that we're bullish on the outlook because it also plays into the clean and green energy transition. For us, it's Boss Energy at the moment is the pick of the bunch with the buy rating. They have cash earnings. They're getting money. They've already got earnings coming through from the Honeymoon mine in South Australia. They've also diversified recently in their portfolio to South Texas in the Altamisa mine, 30% stake there, which is also close to Obviously, the Microsoft's nuclear power plant, they're just turning back on. So that's really good upside potential and drives demand for a company like Boss Energy in South Texas there. They've got a really strong management team with Duncan Crabe in the team, and we really like the outlook for what they're doing. They've got cash coming in and they've got uranium heading to the market. So those are the commodities that we're looking at the moment, and I've got 18 seconds left, so I hope you enjoyed that presentation, and I hope you have a wonderful day. There's some fantastic speakers ready to come up onto the stage and tell you about their exciting products, and projects, not products, and I'll be sticking around today if you have any questions for me. Thank you.